So, you are a European who's decided you want to start investing and you are on the path to building financial freedom. You read some articles, watched some videos, and you've made the decision that you don't want to deal with individual stocks and that ETFs are the way to go. ETF stands for Exchange Traded Fund, and these are basically baskets of many stocks. This will simplify your investment journey, lower your risk, and give you access to hundreds or even thousands of companies at the same time. But you also probably realize that although ETFs are a more simple way to invest, there's still a learning curve. Where do you search for them? What do you look for? What strategy do you choose? The internet is full of advice on that topic, but not for people living in the EU. You see, here we can't buy those famous ETFs you see all over YouTube, like SPY, QQQ, SCHD, or DGRO. Our governments have banned us from even trying. But you don't need to worry, because in this video I will show you how, as a European, you can still build a fantastic ETF portfolio that can last for the rest of your life without even touching the famous American ETFs. I will cover 6 core approaches you can use to build it. 3 of them foundational and more beginner friendly, and the other 3 a bit more specialized but still simple enough for a beginner investor. For all of them, I will show you details how you can find and compare the ETFs. So let's start. My name is Ognian Stanov, and after achieving financial freedom, I've helped thousands of people start investing both in my program and free classes. And today, I will help you start your European ETF investing journey. Let me now introduce you to our tool of the day, the website justetf.com. Here you can find all the ETFs you are allowed to invest in as an investor living in the EU. Next, you will go to the ETF screener right here. When you open it, this page will appear. The first thing you need to know is that the number of ETFs you see will be determined by the country you set from your settings. I have found that I have the biggest selection if I choose Germany or France, so I go with that, and I also choose the language I want. Alright, now we are ready to search. It might seem daunting, but I will make it simple for you. The first thing we do is we click equity right here on the left, and that leaves only ETFs focused on normal stocks. By the time the video ends, you'll understand what I mean. Don't worry for now. Now, we have to select the columns which will help us filter the funds. We do it here, and we pick these columns. Now we are ready to start. So the first strategy you can use is the simplest one. For all you lazy people, don't jump right into it. It doesn't mean it's the best. With this approach, you basically invest in one ETF that includes all the biggest companies in all the countries in the world. When you do that, the percentage you have in each company will be determined by how big it is. So the bigger the company, the bigger percentage you have in it. So in order to do that, you go to the left side below equities and click region, then world. The result looks like this. For that strategy, it would be best to sort them based on size, because otherwise you will get a lot of distortions, which we will talk about later. Since you are looking to create the broadest possible base for your investment here, it is not a good idea to look at sector-specific ETFs like, for example, AI or energy ETFs, even though they still count as all world and hence will appear in your filter. The idea here is to buy the biggest possible amount of stocks with one ETF and call it a day. So now that you have done this, you will have to make a choice. Do you want to invest only in the developed markets or literally the whole world, including emerging markets? For those that are new, developed markets are countries like the European ones, USA, Japan, Canada, etc., which have stable rule of law and older, more established economic systems and stock markets. The emerging markets, on the other hand, are countries that are in a transition and might have higher growth opportunities, but also higher risks at the same time. The higher growth opportunities might be there because of the rapid development that has already happened in the developed markets. However, wars, hyperinflation, dictatorships, and revolutions are more frequent. So when you make your decision about that, it will dictate the ETF you choose. Yes, you will have to make your own choice. If you expected me to tell you exactly in which ETF to invest, then I will disappoint you, because this is both immoral and illegal, and every single YouTuber who does it is breaking the law. First, it's immoral because I don't know your circumstances and I should not be telling you what to do. And second, it's illegal because it will be financial advice which neither I nor anyone on YouTube can give you. Alright, after you make the choice about whether you want to exclude emerging markets or not, you are left with 2 types of ETFs. The first types are ETFs like these. If you go to the description, you will be able to see exactly what the ETF invests in. Here you can see that it follows an index which tracks 23 developed countries worldwide. Think of an index as the rule-based strategy that the ETF is passively following. This here means that this ETF will only invest in the developed world, and you can confirm that by going to the countries and see the list. On the other hand, you have ETFs like this one, the Vanguard FTSE World ETF, which invests in both developed and emerging markets worldwide. This will be the widest possible ETF you can buy because it has over 3,600 stocks from all around the world. If a company gets big enough to actually matter, you will have it in this ETF. If you go to the holdings, you will see that, for example, it has the Taiwan Semiconductor Manufacturing Company in it, which is not in the previous ETF. This is because Taiwan is classified as an emerging market. So by investing only in the developed markets, you will have missed the company on which basically the majority of the chip manufacturing depends. Whether that's fine for you and you prefer the lower risk, but less broad spectrum of the developed markets, is your decision to make. Okay, moving on to the next strategy. This one is for people who want to focus on the maximum amount of growth of their money and are less worried about broad diversification or passive income. They probably don't need to use the money and are sure they won't need it for at least the next decade and just want to grow it as much as possible. For the growth strategy, you will be focusing on ETFs with proven track history of price appreciation and future growth potential. Finding ETFs here is a bit tricky because the growth filter in the strategy drop-down in just ETF frankly sucks. If you choose it and sort them according to the results in the past 5 years, you will see that they are even worse than the total world stock market ETFs or a basic ETF like the S&P 500. So we have to take a different approach. What we will do is leave the filters open and sort according to 5-year return. Now, the issue here is that you will come across probably very narrow ETFs, meaning that, for example, the best performing ones we see here are semiconductors ETFs, which is basically a subset of one economic sector or simply one sector in one country. For example, the USA technology sector. Now, these ETFs have their place, but it's a bit more advanced and I will cover it later in the video and you will see why. For now though, we want to keep it broader. Some filters that can help you here is the accumulating filter under use of profit. When companies make a profit, they sometimes decide to distribute it to the owners, which is called dividend. If an ETF is accumulating, it won't pass the dividends to you, but instead it will reinvest it back. These ETFs are called accumulating ETFs. Since with this strategy you want to maximize the growth and won't be needing the money for years, even decades, you choose the accumulating one as opposed to distributing, which distributes the dividends in your account as cash. A second filter which might help is to only pick larger funds above 500 million euros. This will help eliminate smaller, more obscure ones, which, as we agreed, isn't appropriate for a beginner looking for the growth strategy. Now, this isn't a hard rule, and you might miss some opportunities for broader ETFs, which just aren't big enough yet. But as I said, we need to work with what we have, as there aren't good filters for broad-based growth funds. As you can see, it helps us eliminate ETFs that only focus on Japan, Taiwan, Turkey, or Japan with additional filters in it. Now that we have those filters and we have sorted them according to their 5-year returns, we can start going down the list and checking the ETFs. Again, because we're not talking about having a concentrated portfolio yet, you probably want to miss the sector-specific ones like the information technology ETFs. Going down, just to give a few examples, we come across a very popular ETF that is known in the USA as QQQ, which is the Nasdaq 100. This ETF is usually used as a proxy for the innovative technological companies and is heavily dominated by American big tech, with some European additions as well. However, the reason I'm giving it as an example is that because, as you can see, it is not just within the USA and not just tech. It also has a few companies from Western Europe and also sectors like telecommunication in it, so it's a bit broader than just USA technology ETF. Going down our initial list and ignoring specific ones, what we see is a fund like the JP Morgan US Research Enhanced Index ETF, which is also diversified in terms of sector and companies. And you can basically open a few more tabs and start researching these and other ETFs you like that fulfill your criteria and requirements. Okay, moving to the next strategy. This is for the passive income lovers, the dividend ETFs. These are funds that focus on dividend-paying companies and distribute the cash straight to you. With that cash, you can decide what to do, spend it or reinvest it in the portfolio to further turbocharge your growth. I will divide this strategy in two: dividend growth and high current income. The difference is that with dividend growth, you are mainly interested in companies that give you smaller dividends now, but have the potential to grow both them and the share price in the future. And for the high current income, you are more interested in getting more money now in your bank account, but you sacrifice future growth. Luckily for us, for both strategies, we have a filter that this time actually works. We go to the equity strategy and click on dividends. Then we also scroll down and click on the distributing part in order to be able to receive the dividends from the ETFs. We will also put a minimum 100 million euro as a size of the ETF to filter out new and unproven ones. Now we are left with only a few dozen of results, which we can go through a lot easier. Now, for the dividend growth strategy, since we don't have such filter in just ETF, I would order them again based on the 5-year performance rate. Why? Because companies that have good record of dividend growth usually produce better total returns than simply stocks with high dividends, and that should help you have the quality dividend growth ETFs at the top. Once you have that, you can start opening them one by one and researching them. Now, since this video will be pretty long as it is, I will not get into how exactly to do it, but basically you want to research how much have their dividends grown in the past to get an idea of whether the ETF is living up to the expectation of a dividend growth ETF or not. When you do that, make sure you're actually using the fund's base currency in which it will be paying its dividend in order to not get confused by the conversion between the currencies. By the way, one of my favorite ETFs for European investors is in that category, and I also currently have it included in my top 4 stocks and ETFs report for the current economic and geopolitical environment we are in. You can get the report for free by going to the link in the description. Let's move to the high dividend approach. Here, you're maximizing the current income you're receiving and are not that interested in the future growth. For that, we go back to our results with the dividend strategy and we sort according to current dividend yield. Once we have that, we can start going through the ETFs one by one and see which fits our criteria. I need to give a little bit of warning here. This strategy is a bit tricky because of a concept in investing called yield trap. Yield trap is a company which has had its share price go down significantly, and because the dividend is measured as a percentage against the share price, when that happens, the percentage of the dividend rises. So sometimes you might have companies or funds performing very poorly, and because of that, the current dividend income you receive will be high. However, those dividends are usually not sustainable and might get reduced in the future. There isn't a simple metric I can give you on how to know for sure, which is why I have the topic covered inside my investing program called the dividend method. But in a sentence, first you need to evaluate the rules the ETF follows and if they protect you against such companies, and then combine that with a little bit of understanding of the top companies in the fund. All right, let's move to the next 3 main strategies, which I have deemed to be more advanced. Now, they are still okay for beginner investors, but at the same time are more advanced. Confused? Let me explain. The reason I call them advanced is because they are riskier and focus on more narrow parts of the market. However, it is exactly because of this that they are able to provide you with bigger returns. And the reason why I include them in a video like this is that people might be beginner investors, but that doesn't mean they don't have some knowledge which gives them competitive advantage. For example, I have friends who are software engineers and are beginner investors. However, even though I am way more experienced in investing, I'm not a tech guy. And when I look at some narrow, let's say, technology ETF, I won't even be able to understand what some companies do. But my programmer friends will be able to understand them much better. They might even be working for some of them. And so even though they're beginner investors, that gives them an advantage. So with that said, let's talk about thematic and sector investing. Thematic investing is a strategy that focuses on investing in companies and industries that are expected to benefit from long-term trends or themes. These themes can be driven by various factors, such as technological advancements, demographic shifts, environmental concerns, or social changes. And sectors are basically the 11 sectors of the stock market. So a way to do that is by going to the filters in Just ETF and opening the theme drop-down menu. From here, you can choose whatever you are interested in. Let's check what the AI theme will give us. Here we have 6 ETFs to choose from. If we open one of these ETFs, the Wisdom Tree AI one, and go to the top 10 stocks, I have not heard of 2/3 of them. However, if you are working or very interested in the industry, you might know all of them, which gives you an advantage over me, even if you're a beginner investor. And we can repeat the same exercise with whatever we want: aging population, blockchain, e-commerce, cybersecurity, etc., etc. We can even invest in a gender equality ETF. What is going on here? Anyways, we can also do a similar thing for the sectors and industries of the economy. By the way, if you're getting value out of this, like the video and subscribe to the channel so that you are notified when I upload new videos like this, and don't rely on the algorithm to serve them to you. The next more advanced way you can build a portfolio is using geographic-based ETFs. Let's say that you are very positive on the Latin American and Southeast Asian markets. Well, you can create a portfolio in which, instead of them having a few percentages of a total world ETF, like the one I already showed you, you pick individual ETFs for them. You do that by going to the filters on the left and choosing a filter for the regions, or the one below it for the countries. That way, you can, for example, put more weight in your portfolio on a region like Latin America or a country like India if you have more specific knowledge or opinion of any of these countries and you want to put more of your money there. And the last approach is based on choosing more than the traditional stock ETFs and going into different asset classes. For example, you might want to have some investments in the gold market or the real estate market in a particular country, but you want to have the convenience of doing it through an ETF, which you can buy the same way as any of the other ETFs. Well, you can also do it here by choosing between commodities, real estate, or precious metals. That way you can not only invest in stocks, but through an ETF get exposure to the performance of, let's say, real estate in the USA or cryptocurrency. It all comes down to your individual preferences. So I know we've covered a lot here, but even this video is only scratching the surface. There is so much more to learn about investing in ETFs, like physical versus synthetic ETFs, calculating dividend growth, analyzing the top few companies in order to understand what you're actually buying, digging deeper into the filters and strategies each ETF has in order to understand what to expect in the future, etc., etc. If you want more help with that, then I invite you to my free investing masterclass, for which you can find the link in the description. It has already been attended by thousands of people and the feedback has been overwhelmingly positive, so I'm sure it will help you on your investing journey as well. I hope this video was helpful to you as a European investor swimming in the sea of American investing advice. Although we are not allowed to invest in the big and famous USA ETFs, as you saw, if you know what you're doing, you can build a great portfolio choosing between thousands of ETFs allowed here in Europe. It's all about increasing your investing education, which this channel is all about. And in order to do that, you can click on that video that should have appeared on your screen. See you again soon.